All right, good morning, everyone. How's everybody doing? Welcome to our Small Business Loans webinar. Thank you for joining us. My name is Sean, and I'm with the University of Laverne Small Business Development Center program. And today we're going to be talking about everyone's favorite money, right? Small business loans. So, eventually as a small business owner, you're going to outgrow your pocketbook, I always say, and you're going to eventually probably need a small business loan because it takes money to make money, right? And so today we're going to be going over some different topics as you, as an entrepreneur, are evaluating the likelihood of you getting that loan pretty much from the eyes of a bank. And we're going to use the 5 C's of credit to do it. Because a lot of times when you go to a bank, they're going to evaluate your loan request in a couple different key areas, and we want to share that with you. But as everybody's getting on the webinar, we also want to take care of some housekeeping items, so make sure you chat in your questions as we go, because we're going to go fast. We're going to cover a lot of different topics, but we want to answer the questions that are on your mind so that we can make this as beneficial as possible. We've got some questions that, for those who have registered, we're going to try to work those into the presentation, but inevitably, as you answer one question, you're going to turn over 2 other questions. So we want to make sure we get your questions answered, so use that chat feature on the right as we get started. I also like to talk a little bit about what the Small Business Development Center is and does, and basically, we're a grant-funded program funded partially by the Small Business Administration and the Governor's Office of Business and Economic Development to help business owners either get started or grow. And we do it 2 ways largely. We do it through webinars and workshops just like this, and we also we supplement, I'd say, those workshops and webinars with free one-on-one business consulting where we can sit down and talk about your business with a business advisor to help you get from A to B. So down in our description, there's going to be the links to the presentation. That's also something I want to mention, as well as some of the links, the documents we might reference in our presentation, but also how to sign up to become a client and meet with a business owner one-on-one. Because, well, we're here to help you be successful, and as we do, we've met with a lot of business owners over the years running this program, and as I put this presentation together, obviously small business loans is one of those areas that often to me kind of feels a little bit like a maze. And so on the screen, we're going to have our slides, and we'll be walking through them. We're going to help you navigate this maze, if you will. So we're going to give you the cheat sheet, if you will, as you're approaching your bank and working with a lender or even an investor to help identify areas that they are looking for to evaluate risk. And we're going to jump right into it. So the first key area of the loan evaluation process, or the 5 C's, is capital. This is really your skin in the game, I'd say. Being able to be organized and answer simple questions like how much do you need and what are you going to use it for are really important areas to focus on. A lot of times that's developing a business plan so you can really hone in on that particular area of the business in your ask, because if you approach an investor or a lender and when they ask you how much do you need and what are you going to use it for, and you reply with, well, how much can I get? That insinuates immediately right out of the gates that maybe you don't have a plan for their money and it might be a little bit higher risk. So heed my caution when I say take care of understanding how much you need in advance and meet with one of our consultants to help you do that. We do a lot of financial projections and modeling. But being organized and being able to answer questions and keeping it simple. I'm a big fan of the KISS model, the keep it simple, silly business model. And what are you trying to do if you're trying to buy a piece of equipment or if you're trying to grow your business in one way or shape or form? Now, startups, if you're starting your business, I would definitely advise you or suggest that don't expect to get 100% of financing from the bank. You're going to need to come in with a chunk of change yourself. That's why I say skin in the game, to really show that you're vested into this project. For startups, it's generally in the neighborhood, I'd say 25%. If you're buying a business, because that's another way of starting a business, you can sometimes get away with about 10% down because, well, the business you're buying has historical cash flow to support kind of, hey, we're making some money here. So you can get away with about 10%. But for my established businesses that are watching today, I would say take a look at your balance sheet. You really want to make sure your equity position is in a good spot and you're not maybe in a negative equity. You don't always need to put in money into the project depending on your historical performance, let's say. But I've got some questions here that I do want to address that some people who have registered for the webinar said, how long does it take to get a business plan? That's a really good question, and it does vary from lender to lender and the type of loan. But the average is about 45 days. You can say 30 days to 60 days, split the difference, say 45. But it really depends on the type of loan. Like if you're buying a building or a business, there might be appraisals and other documents that require time to evaluate or in your due diligence. So it's really dependent on your business, what you're trying to do. But that's a good ballpark figure. And the other question is, how important is the business plan? I wanted to work that one in here because I can't stress it enough. It's very important. If you're looking to start a business or buy a business, definitely going to be one of the requirements, probably from your bank. But if you're an established business, it's really just good to go through and hone in on how much you need. Because, well, if you ask for too much, you're essentially financing, working capital that you don't necessarily need. If you ask for too little, now you're talking about having to go back to the bank because you ran out of cash and refinance and pay additional closing costs. So this is where I really want to take a moment and stress the importance of understanding how much you need and what you're going to use it for. And that's really where we spend a lot of time at the SBDC working with clients to hone in on that. So when you approach the bank, you can be approaching them in an organized manner. So that's the first of the 5 C's, capital. Next, the big thing I would recommend is, or not recommend, the next C is capacity. This C really stands for your ability to repay, and largely based on history of profits. So if you're a startup, you might not have a tax return that shows your profitability, but you can basically really dive into the financials of your financial projections to help say, okay, we know our numbers well enough. But that's where, for my startups that are watching today, I would say the bank is really going to be looking for outside sources of income. Everything from spousal income, maybe you have other businesses, rental properties, etc. Because yes, we're giving this loan to the business, but the business for startups is largely projection based. So they're going to be looking for outside sources of income to say, okay, how are we going to repay this loan based on historical cash flows for the applicant or the business. But mainly for my businesses that are established, this is where you're going to be looking, the bank is going to ask you for largely 2 documents. And I want to play out a quick example because they want to be able to see, can this business service the debt that they're asking for? So let's play out a quick example real quick. And let's say we've got a business that's doing about $42,000 in net income based on our tax returns. That's the first document they're likely to ask you for. How much did you make last year? And we're going to add back in things like depreciation to get to what's called EBITDA, or the true earnings of the business, because depreciation is a non-cash expense. Then the second thing they're going to ask you to do is to fill out a debt schedule. And basically just listing out, okay, what's the debt that's on the business right now? And let's say we have existing monthly debt. We got a term loan out there. We're paying about $1,200 a month. Then we look at what we're asking the bank for. This is the new debt. So let's say we're asking for $150,000 at 9% over 7 years, purely fictitious numbers, but that boils down to about a $2,400 a month payment. And since this is monthly, we want to look at the debt annually because our earnings are annual. So we'll multiply that by 12. And with these 2 figures, we can basically divide now and get to a ratio that banks use that's referred to as a debt service coverage ratio. What we're saying here in a nutshell is we have $1.25 in earnings for every dollar of debt that the company has, and including the money we're asking for. Now, 1.25 is kind of general standard where you want to be. It's a buffer. Say, okay, but if you go lower, I do know lenders that can go 1-to-1, but really the lower you go, the more leverage you're saying you are, and you really don't have the earnings to support the debt you're asking for. So this is a really key concept, and of course, you can always divide, the formula here is to answer that question I brought up before and evaluate, okay, how much can I get? Because it is a legitimate question, but you need to evaluate it before you go to the bank. And especially right now, it's, February, end of February, March, it's tax season. One of the lenders I worked with put it this way, and I really respect her opinion. She says, sometimes you got to reconcile your desire for financing with your willingness to pay tax. So right now, for my existing businesses out there, if you're thinking about raising funds or money this year to do an XYZ project, you're going to be meeting with your CPA, and generally your CPA is trying to lower your tax obligation. And you really want to let them know and have this conversation like, no, we're going to be seeking financing, so we're going to have to pay some tax and show some profitability here in this business to adequately tell the story. And along the lines of telling the story, especially working with your bank, you're going to be telling their story in your business plan and things like that. But when you're looking at your tax returns, a lot of it's just financial numbers. And they're looking to you to adequately understand what happened last year. So if the roof caved in or you had some one-time expenses that really severely lowered your profitability last year, you're going to want to have to let them know this happened and it's not likely to happen again because we got it fixed, right? But there's some storytelling that needs to be done here, not only for the project at hand and what you're trying to do, but also the history of the business and its profitability. So they'll usually ask you for about 3 years tax returns, a debt schedule, and we have a list of about 16 other documents that they're going to ask you for that are sometimes easy known documents, and sometimes there's like, oh, what do they need this for? So that's where the SBDC comes in to help you navigate and get best prepared as you work with your lender. So at this point, let's see here, the one-time expenses. We don't have any questions on this, but I'm sure there are going to be some that come up, so make sure you chat in your questions. But let's say you've got your business plan, your established business, everything's good, and you got some good financial figures to work with. You're going along, and then bam, do not pass go, do not collect $200. And that's sometimes simply because of the conditions C. And those conditions are largely the industry that you might be in. It's important to be upfront with your lender and yourself if you're in a risky industry. And I'm throwing this slide up just as an example, and it's kind of old. I think it's took from 2014, 2015, but these are like the top 10 riskiest industries. And as a business owner, you should know if you're in one of these industries, it's going to be a little tougher road, I'll say. Not impossible, but tougher. And you should remember when you're working with your lender to see if they finance your type of industry. If you're a corn farming business and or let's see, DVD and game video rentals. Nowadays, everybody's streaming. We're on YouTube right now, right? So even if I had the best DVD and video game rental business in town, the bank is going to be looking at some of the industry data that's saying, okay, we made X number of loans to Y number of businesses, and the default rate was either high or low. So they're going to kind of target certain industries or be a little leery of others for that reason. Not to say that you don't have a good business, but just be upfront with your lender. Other things to consider in the area of conditions would be things like your own licenses and permits and approvals from county or federal or state agencies. If you're looking for financing and there are other authorities that will give you permission to do this type of business, you're going to want to have those in order. You're going to want to really have those conversations with your bank to make sure that you're in the same understanding of your type of business, what your project is, etc. So sometimes this one comes out of nowhere, but think about it. We do have industry research at the SBDC to help you kind of see, okay, what is the projected growth rate for the industry, etc. Next, and I know we're moving through this fast, so again, chat in your questions. But the next C of the 5 C's is our character. And this really speaks to our reputation as a business owner or business owners. And so the important thing here is knowing your business and largely your personal credit score. Anybody who owns 20%, I'd say, or more of the business is considered more of a principal owner in the business. And you're going to want to know, okay, what is your score? And I know I have a question here, is like, what is the minimum score needed? Again, that's going to vary depending on the bank themselves. But I've seen banks go as low as 620. But granted, you're going to want to take care of some of those issues before approaching the bank, largely because you want to get a good interest rate. And the lower the score, probably is going to be a little bit higher rate and indicate that you might need to take care of some personal items first. But my rule of thumb, 700, 720 above. I mean, nowadays, I think people are pretty good about monitoring their credit and knowing what's on there. That's really what I would hit home here, is being able to explain anything like bankruptcies, 3 years or more, or short sales, what's on the report and why. The banks are going to be interested in the why, because there's a story for everyone out there, and we've all fell on hard times. Let's be honest. So, but being able to explain that and why, and what you've done about it, and the plan is going to be really important. Another thing that kind of falls into this character or this reputation C is your industry experience, especially for my startups out there. 2 years of industry experience or more is really almost going to be minimum requirement. But for my established business owners, let's say you've been running this business for 20-something years or more. You probably haven't updated your resume in a while, and it's going to be weird of me to ask you to do that as you apply for a loan. But here's the deal. Your loan application, your taxes, your debt schedule, your lease, your everything, including your resume, or sometimes they'll have a management profile sheet that you can fill out. It's going to be sitting on top of somebody's desk somewhere, and they're going to be evaluating your business based on your reputation or your ability to, service this business and this debt. And so really going back and updating your resume, not to get a job, but to get a loan, is kind of a funny thing to throw out to some business owners who have been in business for a long time. So to really articulate your management experience in that specific industry. It's just kind of a funny one, but I want to throw it out here too because, again, it's going to be sitting on someone's desk who doesn't know you. And the only way for them to get to know us is largely through a resume, to show as much quantitative figures as we can. Like, we grew it from X sales to the Y sales and manage this and manage that. Especially anybody who's going to be in a management role, the bank is going to be looking heavily at their experience. So just food for thought. We do not have any questions here, but keep them coming on the chat because that we're just about out of the gates when we're talking about our 5 C's. And again, I know I'm going fast, but collateral. This is the last C, and it's often a sticking point. So you really got to have a heart-to-heart with yourself because this C really stands for your guarantee to repay this loan should everything go sideways. And I say you got to have a heart-to-heart with yourself because, well, what are you willing to give up to repay this loan? No one likes to talk about it, but we got to hope for the plan for the worst and hope for the best, right? So thinking about your collateral that you're willing to secure this loan. Most banks are going to want to see at least a 1-to-1 collateral. So if I'm asking for $150,000 to buy a business, they're probably going to want to see $150,000 in collateral to secure that loan. But let's say the business I'm buying doesn't have a whole lot on the balance sheet. A lot of it's maybe, let's say, goodwill, or inventory, and things that have largely been written off. So where am I going to get that collateral? They're going to, outside of the business, and that's where you've got a screen, on the slide, we've got a screen that shows kind of different types of collateral and their respective discount rates. Because they're not going to give you dollar for dollar collateral for your inventory, let's say. They're going to give you 10 cents on the dollar in some cases. These are just examples. For your inventory, because if you couldn't sell it, what makes the bank think that they're going to be any better at selling it? So they're going to discount this stuff heavily should they have to liquidate. And again, it's a bad thing to think about, but this is something going into it you need to. So, new equipment, machinery, of course, yes, they might give you 100% collateral, dollar for dollar, but used, there's some different rates there. But as I mentioned before, let's say there isn't enough collateral in the business to secure the loan. That's where the bank is going to largely look to outside resources. And by outside, I mean you and your owners. So that's at the bottom, you see like guarantor assets pledged. Your house, your cars, your vehicles, your rental properties. Thinking about, okay, what equity positions are in those particular assets, and are we willing to pledge them? Heart-to-heart moments. And obviously, you're going to be making sure that you're okay with your spouse or significant other, that you're okay with putting up the house. Sometimes that's a deal breaker for some of my clients. But if you're vested, if I'm the bank and you're not willing to secure this loan, what does that tell me? It's going, okay, well, how serious are you? And this is a really important C. But some people say, well, Sean, what if I don't own a home? I don't have these other collateral. The collateral is an important part of the loan underwriting process, but that's where SBA loans tend to come in. Because, well, let's be honest, not a lot of businesses have a lot of assets to pledge. So the way SBA loans work is you're not getting a loan from SBA or the government. You're getting a loan guaranteed. You're getting a loan from your bank that's guaranteed by the government. Sometimes up to 70 to 85% depending on the loan size and the loan program that you're in. But basically, the bank says, hey, SBA, I'm willing to do this loan to to Sean's small business, but he doesn't have enough collateral, and I'm a little leery based on my policies for collateral. Would you be, if you guaranteed this, I think I could get some access to this small business owner who's going to create some jobs and grow, et cetera. So SBA says yes, of course, based on certain parameters, and you can't. There's some caveats there, like you can't be like a convicted felon, and you can't use it for gambling or businesses of a sexual nature. So there's some extra rules and stuff to abide by. But assuming you do, you're basically getting a loan with an insurance policy against it that's provided by SBA. With any insurance policy, you're going to pay a premium, and those are going to be in guarantee fees. But you're probably willing to pay guarantee fees if you can get access to the loan, the financing you need to grow your business. So here on the slide, I've got a little cheat sheet that you can, and I'll include the link in the description below. If you scroll down and click see more, there's like a loan guarantee quick reference guide. And the big thing when people say SBA loans, the big mothership, if you will, of SBA loans is 7A. And there's a lot of variations thereafter. So look at that column. You can see the guarantee fees, you can see the guaranteed amounts, and et cetera. But so you're able to get access to the financing you need. That's how SBA is able to help you as a business owner by insuring the loan product made by the bank. So you can kind of think of it like a FHA loan for first-time home buyers, SBA loans for business owners. So in a nutshell, really. So, but this is a really important area that you're going to need to qualify for some other characteristics for the loan as well as a business plan. Going back to our first C, capital. How much and what for? So we talked about the cheat sheet. And lastly, what I'll say before we turn it over to questions is once you've found the way out of the small business loans maze, it's largely then simply the entrance of the sales and marketing maze. So now you got more money, hopefully to do a project, but again, with that money comes, you have to service the debt. So now we got to make more sales. And that's where, again, this is kind of that cycle. It takes money to make money, but being able to implement and increase your sales is really what we're talking about. So I want to end before we go to questions, and I know we went through it fast, so I could talk for days on this, so I try to focus on just my main core points that I hit on a lot with my clients. But I want to end with being able to sign up for one-on-one advising at our SBDC. It's just at lavernesbdc.org. You see the sign up button now. Once you sign up, you become a client. We pair you up with a consultant to be able to talk about your business. But as it relates to some of the questions, we addressed, I think, a lot of them that were submitted in advance of our webinar, but let's see if we have any questions online right now. So let's see. I have one right here, and it says, I have school and car loans and have low savings. Can I start a small business, or do I need to solve these debts first? Oh, good questions. I mean, everybody's going to have debts on their business. I think the important thing is when you're looking at it from a personal income standpoint, can you service those? So I wouldn't say you need to pay off your student loans first. You just need to factor in those loan payments, as you're talking about your personal living wage. So if you need to pay yourself a certain amount of money from the business to cover your light bills, all those necessary expenses, the bank is going to look at that, and they're going to add those, not only your loan payments for your car and your student loans, but also groceries, rent, or mortgage if you own a home, all those regular bills. They're going to factor that into, that equation. So I wouldn't say you need to pay them off first, but you need to consider them, and then consider the income sources to your household. So do we have any other questions right now? It looks like we just have the one. But so I will take this time to just say thank you so much for joining us. If there's no other questions, I would just say, if you, oh no, that's what I want to mention. The slides to my presentation are going to be down below, as well as some of the links. But if you like the webinar, make sure you give us a thumbs up. We'd love that. But also subscribe to our channel because, we're going to be talking about buying a business in our next webinar. And, thank you very much for joining us, and we hope to see you next time. Thanks for watching.